You know that feeling when a headline number just screams trouble, but then you dig into the footnotes and you find this story of strategic brilliance.
Yeah.
That's exactly where we are today. Welcome to the Deep Dive. We're breaking down the Unisys Corporation Q3 2025 financial results call, and we are going to get to the core strategy.
Our mission is, well, pretty clear. Unisys is an IT services provider, and they are under massive market pressure. Client cost sensitivity is, through the roof, and the competition is just fierce.
Right.
So the core question is, how did they deliver a revenue miss, but actually maintain or even improve their profitability? We need to unpack that pivot.
Okay, let's do it. Let's start with the hard facts. The top line story was pretty tough. They delivered $460 million in revenue. That's a 7.4% drop year over year.
And it's actually closer to 9% if you look at constant currency. It was definitely below what they were expecting internally.
A clear miss. But management immediately wanted to shift the focus, didn't they? Right to the bottom line.
They did, because that's the whole thesis right now. Their non-GAAP operating profit came in at $25 million. That's a 5.4% margin.
Which was right on the money, expectation-wise.
Exactly. It shows that the margin discipline they've been talking about is already starting to work.
So if the margin held up, let's get into the weeds on the revenue miss. Why did they undershoot? What happened?
It was primarily timing. I mean, they were very quick to point out that about $12 million in revenue from a huge license and support renewal.
The LNS business.
Right. That deal closed literally a few days into Q4. So the revenue isn't gone. It shifted, which, gives Q4 a little tailwind right out of the gate.
But it wasn't just timing, was it? We saw some big macro factors biting hard here.
Oh, absolutely. Two huge external factors hit their services business, XLNS. First, the PC refresh cycle is still basically stalled.
And Microsoft didn't help.
Not at all. By extending security support for Windows 10, they basically took away the immediate need for a lot of companies to upgrade their hardware. And more importantly, the field services that Unisys sells alongside that.
And the second factor?
The public sector. It just pulled back hard, especially U.S. state and local clients. The uncertainty around the U.S. government shutdown, even just the threat of it, it froze everything.
On that project spending, yeah.
Immediate delays, discretionary IT spending just stopped.
Okay, so it's a difficult landscape. But looking forward, they still felt confident enough to reiterate that margin guidance.
They did. They narrowed the full-year revenue outlook to a decline of between 3% and 4%. So they're admitting the softness is real.
Right.
But they reaffirmed high confidence in hitting that improved non-GAAP operating margin of 8 to 9% for the full year.
That margin confidence is everything. But we have to talk about the GAAP results for a second, because the headline there was a net loss of $39 million.
Yeah, and if you're just looking at the headline, that looks terrible.
Right.
But here's the reality. That loss was almost entirely manufactured by a single one-time non-cash expense of $228 million.
That's the cost of cleaning up the balance sheet, right?
Precisely. It's tied directly to their aggressive pension removal strategy. So once you strip out that massive one-time charge, which is what the non-GAAP numbers do,
you see the real operating picture.
And it's exactly where management wanted it to be. They basically paid an accounting price this quarter to buy long-term financial stability.
Okay, let's pivot and unpack the two core businesses, because this is where the long-term story is. You've got the cash engine, LNS, and the services arm, XLNS.
And that LNS bedrock is still the most powerful profit driver. They expect it to deliver $430 million this full year.
That number feels rock solid.
It is, but here's where it gets really interesting for the long term. Management didn't just reaffirm this year. They actually raised the guidance for average annual LNS revenue for fiscal 26 through 28.
Wait, they raised it in this environment?
They raised it to $400 million. That's up from their original expectation of $360 million.
Wow. $40 million in raised long-term guidance?
Yeah.
That's a huge jump. Is that real? Is that structural? Or are they just trying to distract from the mess in the services division?
It's a fair question, but it seems to be rooted in data, not spin. They're seeing exceptionally strong client consumption and really high retention inside that software ecosystem.
So it's not just about renewing old contracts.
No, it's about clients using more of the product. It proves the software is sticky, it's essential, and that stickiness translates directly into a higher, more predictable cash flow for the business for years to come.
That LNS engine is why they can afford to play this long game.
Exactly.
So speaking of the long game, let's talk about the pain point, XLNS. Excluding LNS, revenue there was down almost 4%.
It was. And with those headwinds we talked about, the Windows 10 thing, the public sector slowdown, that's some serious pressure.
And they don't see that public sector issue fixing itself overnight.
No, they were very clear about that. They said, don't expect a light switch effect recovery, even if the government shutdown fears go away. That hesitation is probably going to stick around for a few quarters.
Okay, so given those major revenue headwinds, here's the paradox we need to understand. XLNS gross margin actually improved. It went up 70 basis points year over year to 18.6%. How? How do you shrink revenue but grow the margin in this environment?
This is the operational discipline thesis playing out in real time. It's not an accident, it's by design.
Okay.
It comes from two intentional actions. First, the attrition of lower margin contracts. They are actively choosing not to chase volume if the profit isn't there.
They're walking away from bad deals.
They're walking away. And second is the addition of higher margin new solutions. When they renew, they're swapping out old, labor-heavy work for new, tech-led, higher value offerings.
And all that was supported by some aggressive cost cutting.
They pulled SG&A savings forward from 2026 into this year. Streamlining corporate functions, getting rid of real estate. They're adjusting their workforce right now to protect that margin no matter how long the revenue slump lasts.
They're controlling what they can control.
Exactly. They're showing, remarkable agility in adjusting their costs to this new reality where efficiency, especially AI-driven efficiency, is changing everything.
That brings us perfectly to the biggest strategic tension of the whole quarter. The AI tradeoff.
Yes.
AI is essential for their delivery efficiency. It helps them improve their margin. But management straight up admitted it comes at the expense of top-line revenue growth.
This is where you see the structural change in the industry so clearly. AI dramatically lowers the cost to serve, but the clients, who are super cost sensitive, demand those savings right away.
So they have to share the savings.
They share the savings,
Yeah.
which means the total contract value shrinks, even if the margin percentage on that smaller contract is better.
Can you give us a concrete number on that efficiency?
Yeah, look at their digital workplace solutions. They have this AI tool, the Service Experience Accelerator. The uptake is enormous. It's causing roughly 40% of all support tickets to deflect away from human agents completely.
40%.
40%. It's a wild number. It just fundamentally changes how much labor you need.
That's staggering. And it's not just cutting costs. They're seeing better user engagement, up 28%, and abandonment is down 24%.
It's better service for a lower cost.
But it means they're doing a lot more work for less money on paper.
Yes. And the question then becomes, where does future revenue growth come from if the very thing making you efficient is also compressing your top line?
The answer has to be winning new business and penetrating new markets, right?
Absolutely. New business TCV was up a pretty robust 15% year over year. A lot of that was driven by XL&S renewals, which were up 78% in TCV.
So they're successfully converting that old low-margin work into modern, high-value deals.
That's the plan. And they're strategically targeting a segment where they think they can really shine, the mid-market. We're talking enterprises with 1 to 5 billion in annual revenue.
A space the big guys often ignore.
Exactly. It's ripe for the picking. They think they can offer a more customized, personal approach, and we saw it work this quarter. They had a big win with a European financial services client and a brand new logo for modern core banking in Latin America.
Okay, let's shift to the balance sheet, which is the foundation for this whole stability thesis, especially that pension de-risking strategy that caused the big GAAP loss.
The pension execution in Q3 was a huge strategic win. They did an annuity purchase, successfully transferring over $300 million of U.S. pension liabilities to a third-party insurer.
And that's more than half their goal.
More than half their $600 million target that they'd set for 2026. They did it way ahead of schedule.
So what's the practical benefit of that for an investor? Why should they care?
Predictability. They've essentially stabilized their future cash contributions. The company is now forecasting that their annual payments won't fluctuate by more than 3% a year all the way through 2029.
They've removed a major source of earnings volatility.
A huge source. And they've done it while maintaining strong liquidity. They've got $322 million in cash and an undrawn credit line.
So stability is the narrative. But we have to acknowledge the near-term risk. that public sector problem isn't just going away.
No, and they were honest about that. They're managing expectations. But despite that softness, their trailing 12-month book-to-bill ratio is still solid. It's at 1.1x. Backlog is flat at $2.8 billion. The demand is there. It's just the timing is stretched out.
All right, as we head into our final segment, a critical reminder to everyone listening. This analysis is based on public source material. What you're about to hear is purely speculative analysis. It is not financial advice. Please do your own exhaustive due diligence before you make any investment decisions.
Okay, so given Unisys's very clear, very deliberate pivot away from chasing unprofitable revenue and towards structurally higher margin, and you combine that with the aggressive balance sheet de-risking,
The trade becomes pretty clear.
yeah, the core trade is betting on long-term convergence.
Yeah.
We think the market is mispricing the stability they've just purchased.
So we are pitching a long margin, short chaos, paired trade.
That's it. We would recommend going long Unisys equity. The main value driver here is the 5 years of financial predictability they just bought. That $228 million non-cash charge. That was the price of admission.
And that value just accrues over the next 5 years, underpinned by that newly beefed up $400 million LNS engine.
Right. And then for the short chaos side of the trade.
This is where we bet against the industry hype.
Yeah, exactly. We would recommend going short a basket of their IT services competitors. The ones who are, as management put it, undercutting on price. They're taking on huge risk, prioritizing volume over profit, and betting that AI efficiencies will magically appear fast enough to save their margins.
A dangerous bet.
A very dangerous bet. The thesis is that Unisys, as the disciplined operator, will see its gross margin profile continue to widen its gap versus these rivals.
And eventually, those competitors will be forced to recognize that risk, maybe through a goodwill impairment.
Similar to the $55 million non-cash impairment, Unisys itself took this quarter in their DWS segment. It was a separate little cleanup item, but it shows they're being realistic.
You are betting that operational discipline wins against the volume hype cycle.
It's a bet that institutional capital eventually rewards stability and high-quality cash flow, which are the core pillars of the Unisys strategy, over just risky low-margin growth.
And that structural tension really defines the whole story here. The biggest takeaway is just so clear. Unisys is sacrificing top-line momentum today to get a structurally higher quality, more predictable profit stream tomorrow.
They're trading revenue volatility for margin stability. They're essentially building a moat of predictability.
And that leaves us with this final provocative thought for you to explore. Can that durable $400 million LNS engine, that recurring software income, be durable enough to offset the persistent AI-driven revenue pressure in the services division, especially if those cost savings keep flowing mostly to the client and not to Unisys' own top line?
The durability of LNS is the anchor keeping the ship steady, while ex-LNS is being strategically dismantled and rebuilt.
Thank you for joining the Deep Dive. All of our notes, disclaimers, and source context can be found linked in the show notes. We'll see you on the next Deep Dive.